Hello students, welcome to the lecture on internal reconstruction of a firm. After the lecture, we will be able to learn the following objectives. Explain the internal reconstruction, understand objective of internal reconstruction, explain the procedure of internal reconstruction, discuss the method and accounting treatment, explain the preparation of balance sheet after reconstruction. Let's start with a brief introduction to internal reconstruction of a firm. When a company which is suffering loss for several past years and suffering from financial difficulties, it may go for reconstruction. In other words, when a company's balance sheet shows huge accumulated losses, heavy fictitious and intangible assets, or in financial difficulties, or is too overcapitalized, and then the process of reconstruction is restored. Reconstruction may be internal and external. External reconstruction. When a company is suffering losses for the past several years and facing financial crisis, the company can sell its business to another newly formed company. Actually, the new company is formed to take over the assets and liabilities of the old company. This process is called external reconstruction. In other words, external reconstruction refers to the sale of the business of existing company to another company formed for the purpose. In external reconstruction, one company is liquidated and another new company is formed. The liquidated company is called vendor company and the new company is called purchasing company. Shareholders of vendor company become the shareholders of the purchasing company. Internal reconstruction. Internal reconstruction refers to the internal reorganization of the financial structure of a company. It is also termed as reorganization, which permits the existing company to be continued. Generally, share capital is reduced to write off the past accumulated losses of the company. The accounting procedure of internal reconstruction is distinct from that of amalgamation, absorption, and external reconstruction. Let's now talk about internal reconstruction. A company might have suffered huge losses in the past, or might have the problem of overcapitalization, or might have overvalued its fixed assets because of inadequate provision for depreciation. Such a company faces the danger of going into liquidation either voluntarily or because of a petition by any of its creditors or debentured holders. In these circumstances, companies have three options: to liquidate the company, liquidation; to reconstruct externally, external reconstruction; to reconstruct internally, internal reconstruction. Internal reconstruction is an arrangement made by companies whereby the claims of shareholders, debenture holders, creditors, and other liabilities are altered or reduced, so that the accumulated losses are written off, assets are valued at its fair value, and the balance sheet shows the true and fair view of the financial position. Forms of internal reconstruction. Internal reconstruction may take any of the following two forms: reorganization or alteration of share capital, reduction of share capital and other liabilities, reorganization or alteration of share capital. Reorganization or alteration of share capital refers to the arrangement of the capital of the company and include the following: increase the share capital by making fresh issue of shares, decreasing the share capital by cancelling the unissued shares, conversion of shares into stock and vice versa, consolidation of shares of smaller amounts into shares of larger amounts, subdivision of shares of larger amounts into share of smaller amounts. A company can alter its share capital if it is authorized by its association. Reduction of share capital and other liabilities. Reduction of share capital is an arrangement under which the capital of the shareholder and sometimes even the claims of debenture holders and the creditors are reduced. The amount made available by capital reduction is utilized in writing off the accumulated losses, fictitious assets, and the overvalued portion of the other assets. When a company has been making losses for a number of years, the financial position does not present a true and fair view of the state of the affairs of the company. In such a company, the assets are overvalued. The assets side of the balance sheet consists of fictitious assets, useless intangible assets, and debit balance in the profit and loss account. Such a situation does not depict a true picture of financial statements and shows a higher net worth than what the real net worth ought to be. In short, the company is overcapitalized. Such a situation brings the need for reconstruction. Reconstruction is the process by which affairs of a company are recognized by revaluation of assets, reassessment of liabilities, and writing of the losses already suffered by reducing the paid-up values of shares and or varying the rights attached to different classes of shares. The object of reconstruction is usually to reorganize capital or to compound with creditors or to effect economies. Such a process is called internal reconstruction, which is carried out without liquidating the company and forming a new one. However, there may be external reconstruction, wherever an undertaking is being carried on by a company and is in substance transferred not to an outsider but to another company consisting substantially of the same shareholders with a view to its being continued by the transferee company. There is external reconstruction. Such external reconstruction is essentially covered under the category amalgamation in the nature of merger. Differences between internal reconstruction and external reconstruction. No new company is formed in case of internal reconstruction. A new company is formed in case of external reconstruction. In case of internal reconstruction, no company is liquidated. In case of external reconstruction, one company is liquidated. Internal reconstruction requires court's confirmation, but external reconstruction can be effected without court's confirmation. Internal reconstruction is a slow and tedious process, but external reconstruction can be carried out easily. In the case of internal reconstruction, the company is able to set off its past losses against future profits, whereas in the case of external reconstruction, the past losses of the old company cannot be set off against the future profits of the new company. Objectives of internal reconstruction. The objective for reconstruction arises when a company has accumulated losses or when a company finds itself overcapitalized, which means either that the value placed on assets is too much as compared to the earning capacity, or that the profits as a whole are insufficient to pay a proper dividend. Apart from clarity, wide acceptance and justice, the reconstruction scheme must take into account the following. The fundamental basis of any proposals is the earning power of the company. Even the interest to debenture holders cannot be paid unless the company's activities are profitable. A very careful estimate should therefore be made of the profits expected by the company in the future. Unless the profits are sufficient to meet all the expenses, including adequate depreciation, interest to debenture holders and other creditors, preference dividend and a reasonable return to the equity shareholder, it would be useless to process with any reconstruction scheme because otherwise the need for reconstruction will soon arise again. Assuming that adequate profits can be expected, the reconstruction scheme should not adversely affect the rights of preference shareholders, not to speak of creditors and debenture holders, unless it is absolutely necessary. Suppose the profits are such that after paying dividends to preference shareholders, little remains for equity shareholders. The preference shareholder may be persuaded to accept a sacrifice either by reduction of capital or by reduction in the rate of dividend, or both, because the alternative to such acceptance of sacrifice may be the liquidation of the company, in which case, due to forced sale, the asset may not realize much and the preference shareholder may not be able to get back what they have invested. If the company is in a very bad position, even the debenture holders may be prevailed upon to accept a reduction of the claims. But so far as is possible, contractual and legal rights and priorities should be maintained. The equity shareholder will naturally have to bear the brunt of the losses and sacrifice. This is not as bad as it sounds, because A, the equity shareholders realize from the very beginning that if losses occur, they have to bear them before anybody else can be called upon to do so. And B, they must have already known that the value of their holding is small due to the absence of dividend. The market price of share is related to dividend and not to the face or nominal value of the share. It really does not matter, therefore, whether the nominal value of an equity share is $1 or $100 or $1,000 as long as it is not zero. Now let's talk about the procedure of internal reconstruction. The following steps are used. Step 1. First of all, the total amount to be written off should be ascertained. This would mean totaling up the debit balance of the profit and loss account, all fictitious assets like goodwill, preliminary expenses, discount on shares or debentures, any fall in value of assets, any increase in liabilities and areas of dividends on cumulative preference shares. If the value of any share can be legitimately increased, the amount of loss would then be reduced accordingly. The other way to get at the same figure would be to add up the present value as a going concern of all the assets and deduct therefrom the amount of liabilities and also the areas of dividend on cumulative preference shares. What is left is net assets. The share capital compared with net assets will show how much amount is to be written off. Step 2. The question now arises as to who is to bear the loss. If the net assets are more than the preference share capital, it is obvious the whole of the loss will have to be borne by the equity shareholders. The nominal value of the equity shares should be reduced by a sufficient margin to cover the loss. If the net assets are not sufficient to cover the preference share capital, or if the net assets are just sufficient, the preference shareholder will have to accept a sacrifice, although their sacrifice will be smaller than that of the equity shareholders. Equity shareholders should not be completely wiped off. If the future earning power of the company permits, the dividend rate should be increased so that, in terms of rupees, the dividend remains unchanged. Step 3. Payment of arrears of dividend. Question arises only in case of cumulative preference shares. In cash, immediately may present difficulties. In such a case, a good method is to issue deposit certificates. This is preferable to using shares because A. It will not upset the voting power, and B. The certificate can be redeemed as soon as the opportunity arises. The rate of interest need not be heavy, but of course it will depend on the future earning capacity of the company. Step 4. Debenture holders and other creditors are affected by the reconstruction scheme only if the total assets in the company are insufficient to cover even the liabilities. Moving on to the next topic, we shall talk about method and accounting treatment. For properly deploying the process of internal reconstruction, following methods are generally employed or used simultaneously. Alteration of share capital as per Section 94, 95 and 97 of the Companies Act, variation of shareholders' rights as per Section 106 of the Companies Act 1956, reduction of share capital as per Section 100 to 105 of the Companies Act 1956, compromise arrangement as per Section 391 to 393 and Section 394A of the Companies Act, surrender of shares, alteration of share capital, subdivision and consolidation of shares. A company may, in a general meeting by passing an ordinary resolution, decide to subdivide or consolidate the shares into those of a smaller or higher denomination than that fixed by the Memorandum of Association, so long as the proportion between the paid up and unpaid amount, if any, on the shares continues to be the same as it was in the case of the original shares. A notice specifying alteration made must be given to the registrar within 30 days of alteration. Conversion of fully paid shares into stock and stock into shares. Stock is the consolidation of the share capital into one unit divisible into adequate parts. While it is impossible of the share capital to be one share, any amount of stock may be transferred. In practice, however, companies restrict the transfer of stock to multiples of, say, $100. A company can convert its fully paid shares into stock. Upon the company converting its shares into stock, the bookkeeping entries merely record the transfer from share capital account to the stock account. A separate stock register is started in which details of members' holdings are entered and the annual return is modified accordingly. Reduction of share capital. Section 100 of the Companies Act lays down the procedure in respect of reduction of share capital. One way of doing this is reducing the paid-up capital. The share capital of a company which has been suffering losses continuously for a long time is not truly represented by its assets. In such a case, any scheme for capital reduction should write off that portion of capital which is already lost. This reduction is a sacrifice by the shareholders, and the amount of reduction or sacrifice is credited to a new account called capital reduction account or reconstruction account. The accounting treatment is as follows. Reduction in paid-up value only. Here, the nominal value of the share remains the same and only the paid value is reduced. Reduction in both nominal and paid-up values. In this case, both the paid-up capital and nominal value of the shares are reduced. Compromise or arrangements. A scheme of compromise and arrangements is an agreement between a company and its members and outside liabilities when the company faces financial problems. Such an arrangement, therefore, also involves sacrifices by shareholders or creditors and debenture holders or by all. Accounting treatment for some of the cases are: when equity shareholders give up their claim to reserves and accumulated profits, settlement of outside liabilities at lesser amount. Liabilities such as sundry creditors may agree to accept fewer amounts in lieu of final settlement. The internal reconstruction procedure. Assemble parallel sets of allomorphs in a single language. Assume that the members of each set of allomorphs were at one time identical and that their phonological differences are the effect of one or more sound changes. Determine the original form for each of the allomorphs. Determine the phonological developments which gave rise to allomorphs variation.
Accounting systems. Single entry and double entry. There are two common systems of bookkeeping. They are known as single entry and double entry accounting system. The first, single entry, is simplistic, recording each transaction only once, either as revenue or as an expense. Single entry bookkeeping is suitable for organizations that have very less transactions, very few or negligible assets and liabilities. But when you need a more sophisticated bookkeeping system, double entry bookkeeping system provides you with the tools necessary to represent your accounting data in a meaningful way for use by the stakeholders. Double entry bookkeeping has become the standard, and is the preferred way of accounting, as it allows businesses to track both the sources and application of money. Accounting methods. Cash and accrual. Two types of accounting methods are commonly used to record business transactions. They are known as cash accounting and accrual accounting. Under the cash accounting method, revenue is recognized and recorded when the cash is received, and expenses are recognized and recorded when the cash payments are made. Under the accrual method of accounting, revenue and expenses are recognized and recorded when the product or service is actually sold to customers or received from suppliers, generally before they're paid for. Single entry accounting system. A single-entry bookkeeping system or single-entry accounting system is a method of bookkeeping relying on a one-sided accounting entry to maintain financial information, based on the income statement. The system records the flow of income and expenses through the use of daily summary of cash receipts and disbursements. The single-entry bookkeeping method records entries once and does not balance the transaction out by recording an opposing credit or debit. A single-entry system may consist only of transactions posted in a notebook, daybook, or journal. However, it may include a complete set of journals and a ledger providing accounts for all important items. Where single-entry system is used. A single-entry system for a small business might include a business checkbook, check disbursements journal or register, daily or monthly summaries of cash receipts, a depreciation schedule, employee wages records, and ledgers showing debtor and creditor balances. Under the method, the intent is to record the bare essentials transactions. In some cases only records of cash, accounts receivable, accounts payable and taxes paid may be maintained. Records of assets, inventory, expenses, revenues and other elements usually considered essential in an accounting system may not be kept, except in memorandum form. Single-entry systems are usually inadequate except where operations are especially simple and the volume of activity is low. Single-entry systems are used in the interest of simplicity. They are usually less expensive to maintain than double-entry systems. Accounting System 2. The double-entry accounting system. Double-entry accounting is a system of organization that records financial transactions in an efficient manner and has been used by accountants for over 500 years. Since the 15th century, when Luca Pacioli first wrote about the practice, the term accounting has referred to double-entry accounting. Double entry accounting uses a system of accounts to categorize transactions. Each transaction that is entered consists of one or more debits and credits, and the total debits must equal the total credits. The rules of double entry system. The double entry bookkeeping system assumes that when a transaction takes place, it impacts two different accounts, one as a debit and the other as a credit. Therefore, each transaction is recorded twice. A transaction may also affect more than two accounts, but its total credit amount will always match its total debit amount. Before a transaction can be recorded, it must be analyzed and classified to determine the accounts it affects and how it affects them. At least two accounts are affected, one with a debit and one with a credit. Some accounts are increased by debit and others are increased by credit.
Let's discuss the preparation of balance sheet after reconstruction. On a scheme of reconstruction being adopted, the entries to be passed are an appreciation in the value of an asset or reduction in the amount of a liability should be debited to the account concerned and credited to capital reduction account or reconstruction account. Write off all fictitious assets including goodwill and patents and eliminate all over-evaluation of assets by crediting the accounts concerned and debiting the capital reduction or reconstruction account. For this purpose, any reserve appearing in the books of the company may be used. If any balance is left in the capital reduction or reconstruction account, it should be transferred to the capital reserve account. While preparing the balance sheet of a reconstructed company, the following points are to be kept in mind. After the name of the company, the words "and reduced" should be added only if the court so orders. In case of fixed assets, the amount written off under the scheme of reconstruction must be shown for 5 years. Now, in the end, let us summarize what we have learned in this lecture. Internal reconstruction refers to the internal reorganization of the financial structure of a company. Reconstruction is a process by which affairs of a company are reorganized by re-evaluation of assets, reassessment of liabilities, and by writing off the losses already suffered by reducing the paid-up values of shares and or varying the rights attached to different classes of shares. Reconstruction account is utilized for writing off fictitious and intangible assets, writing down overvalued fixed assets, recording new liability, etc. If some credit balance remains in the reconstruction account, the same transferred to the capital reserve account. A company might have suffered huge losses in the past, or might have the problem of overcapitalization, or might have overvalued its fixed assets because of inadequate provisions for depreciation. A scheme of compromise and arrangement is an agreement between a company and its members and outside liabilities when the company faces financial problems.